Christina Calvo, World Bank Country Manager for Uganda, members of the Diplomatic Corps, distinguished guests, distinguished panelists, staff of the World Bank in Uganda, distinguished guests, ladies and gentlemen. I would like to begin by commending the World Bank for publishing the 8th edition of the Uganda Economic Updates series, which over the last few years, has provided a valuable source of economic analysis for everyone with an interest in the Ugandan economy. I would also like to thank the presenters, discussants, and other contributors for all the important insights that they have given us this morning. Given the main theme of the latest economic update, I would like to take this opportunity to offer my own personal perspective on the development of the financial sector in Uganda, its role in the economy, and the challenges which it faces. To begin with, I think that it is important to recognize the progress which the financial sector, and especially the banking sector, has made over the last decade. Between 2005/6 and 2015/16 fiscal years, commercial bank credit to the private sector expanded by more than threefold in real terms, at an average real rate of growth of 12% per annum. Although bank deposits also grew strongly over this period by 2.5 times in real terms, there was a marked rise in bank intermediation, with the ratio of bank loans to bank deposits rising from 53% at the beginning of this period to 70%, which is a remarkable improvement. Secondly, there has been a notable strengthening of competition in banking markets. The Herfindahl-Hirschman Index of market concentration in the banking market fell from 1508 in June 2006 to 909 in June 2016. Fell from 1508 in June 2006 to 909 in June 2016, denoting a substantial reduction in market concentration and therefore an implicit increase in competition. The fact that competitive pressures have intensified in the banking market over the last 10 years is also reflected in a secular decline in the industries, in the financial sectors after tax returns on equity, from 32% in 2005 to 6 to 14% in 2015 stroke 16. I think it is no longer tenable to argue that banks in Uganda make excessive profits. Thirdly, there have been occasional incidents of bank distress and failures over the last 10 years, but prompt regulatory interventions by the Bank of Uganda have ensured that the interests of depositors have been taken care of. Indeed, the interests of depositors have always been fully protected, as was recently the case with the resolution of Crane Bank. This is, of course, in line with the mandate given to the Bank of Uganda under the Financial Institutions Act, which prioritizes the safety of customer deposits. In that regard, therefore, I do not understand why the economic update should have concluded that there are low levels of public confidence in formal financial institutions which discourage the public from holding bank deposits. This conclusion is not borne out by the rapid growth in both the number of bank accounts and the real value of bank deposits over the last 10 years. Notwithstanding the strides made by the banking industry, I agree it still faces major challenges. Particularly, the cost of doing business is rather high, but this is partly because the industry has not yet realized optimal economies of scale in its growth. As a result, annual operating costs average approximately 11% of income earning assets, which accounts for a very large share of the interest rate spread. But the spread will only be reduced when banks can become more efficient and when they reduce their operating costs. I believe that automation and new technologies to deliver financial services will offer avenues for banks to reduce their operating costs over the medium to long term, although this will also expose banks to new forms of operating risks. Banks may also be able to exploit synergies with other financial services such as insurance to improve efficiency. The economic update argues that, and I quote, the high cost and limited access to credit has become a binding constraint on Uganda's economy. I am afraid I cannot believe that. While I do not dispute that bank lending rates are too high and need to be reduced in a sustainable manner over the long term, I do not think that the claim is really tenable. It implies that if only banks and other financial institutions could lower their lending rates and thereby expand the volume of their lending, substantial numbers of businesses in the real sector of the economy would be able to borrow money for investment in order to expand their output and thereby both service their debt and increase their incomes. Unfortunately, the conclusion that access to credit is the binding constraint on economic growth is premised on a rather over-optimistic view of the real sector and its borrowing capabilities. Formal sector creditworthy businesses, which are the main business clients of the commercial banks, comprise of a small share of the Ugandan economy. It's a very important point. Formal sector creditworthy businesses, which are the main business clients of the commercial banks, comprise a very small share of the Ugandan economy. There is a much larger pool of informal businesses and micro enterprises, but the capacity of this sector to utilize credit effectively is constrained by a raft of problems, including scarcities of business and technical skills, high costs of inputs, and often volatile market conditions. The ability of these businesses to make profits consistently and thereby to service their loans is very precarious. The problems are most acute in smallholder agriculture, where qualitative changes in agricultural practices are a prerequisite for farmers being able to utilize credit productively. Above all, land reform is also needed to support the transformation of agriculture in many parts of Uganda. Unfortunately, we have been waiting for this reform for too long, and it's not coming anywhere near. The argument that micro loans alone can transform the fortunes of the household enterprises doesn't hold water. certainly the evidence, empirical evidence in Uganda and elsewhere in Africa does not support that. In addition, attitudes towards borrowing are poor throughout society. Loans meant to fund business expenses are sometimes diverted for personal expenses or speculative purposes, and the culture of loan repayment is extremely weak. Until a much stronger private business sector can develop in Uganda, characterized by good modern business management and a clear separation of business and personal interests on the part of business owners, it will be very difficult for banks and other financial institutions to further raise the level of financial intermediation in Uganda. To conclude, I believe that it is really necessary to be realistic about what can be expected from the financial sector. The shallowness of the financial system in Uganda reflects the structure of our economy much more than the deficiencies of the financial sector itself or of the institutional and regulatory environment in which the financial sector operates. In many respects, technology, productivity, levels of professionalism, and the application of modern business practices, in these respects, the financial sector is one of the most advanced sectors of our economy. You don't think so? In many respects, technology, productivity, levels of professionalism, and the application of modern business practices, the financial sector is one of the most advanced sectors of our economy. That's what I believe. Most of the other sectors of the economy are not as advanced as the financial sector, and some, indeed, lag far behind the financial sector. It is the structural problems afflicting the real sectors of the economy which provide the largest obstacle to greater use of financial services and especially credit in Uganda. I thank you for listening to me, and I apologize for taking so long. Thank you very much. Finished. Thank you very much, ladies and gentlemen. Despite my comments, this has been a fantastic event. Thank you very much.